This video is about bond valuation. What is a bond? Bond is a long-term debt instrument. It is also called fixed income securities because the payments or the income offered by bonds are fixed and it's secured. Borrower or company agrees to repay a fixed amount of principal at predetermined maturity date, and then a borrower or company agrees to pay a fixed amount of interest over a specified period of time. The diagram shows how the bond is operated in a company. First, number 1, the issuer issue bond to the investor or lender. So in this transaction, lender transfer money to the borrower. So the borrower will use that fund or that amount of money to finance a business project or any business operation. That is point number 2. Number 3, the business will generate income. Then the borrower will use that income to pay a predict interest and pay principal at the maturity date of the bond. So this is how bond operated in the company. Interest rate and bond. So the behavior of interest rate is the single most important force in the bond market. Interest rate and bond price move in opposite direction. When interest rate rise, bond price fall. When interest rate drop, bond price move up. Bond market are bullish when interest rates are low or falling, and bond market are bearish when interest rates are high or rising. Let's compare bond with stock. Compared to stock, bonds offer lower return. And the main benefit of bond, people invest in the bond because first, bond offer lower risk. Second, bond offer fixed and stable current income. And third, bond offer diversification. The most important thing, bonds add an element of stability to a portfolio. So the diagram shows that if you compare the return and the bond with a stock, you can see that the return of bond is lower compared to the stock. If you compare in terms of the volatility, means the changes of the return of bond is more stable compared to the return in stock market. If you see the changes or the volatility in the stock market is very high compared to the return in the bond. That's why we said bond has lower risk and it offers lower return compared to the stock. These are some of important features of bond. First, coupon. Coupon is amount of annual interest income. So if you invest in bond, you will receive coupon every year. The second one is principal, or sometimes we call it as a par value. Par value is the amount of capital that must be repaid at the maturity. Let's say you buy a bond with a par value of 1,000. That means at the end of the bond period or at the maturity period of the bond, you receive 1,000 ringgit. Maturity date is the date when a bond matures and the principal must be repaid. Next, we have call feature. Call feature allows the issuer to repurchase the bond before the maturity date. And then we have call premium. Call premium is the amount added to bond's par value and paid upon call to compensate the bondholders. The last one is call price. Call price is the bond's par value plus call premium. How to calculate coupon payment? Let's say you have a 20 years bond that pays 9% coupon per annum with par value of 1,000. So coupon payment is equal to coupon rate times par value. So in this example, coupon rate is 9% times 1,000 par value. That means you receive 90 ringgit per year. This figure shows how the bond without call feature. In year 0 means at the time the bond start in the market. So companies sell a bond at issuing price of bond. Okay, so let's say the bond is for 20 years. So bond will expire. The maturity date will be 20 years. So during the holding period of the bond, company needs to pay investor coupon payment every year. And then at the maturity date of the bond, company needs to pay investor principal or par value. And then company also needs to pay the last coupon payment to the investor. This is bond without call feature. This diagram shows how bond operated if the bond have a call feature. In year 0, company sell bond at issuing price of bond. Then company need to pay investor coupon payment every year. Let's say the bond has a call feature. That means after certain period, company can repurchase the bond. So at the call date, let's say company call the bond or repurchase the bond, then company needs to pay investor call price. So call price basically is a principal or par value plus call premium. Then company needs to pay the last coupon payment on the call date of the bond. After a company repurchase the bond, company doesn't need to pay any coupon payment to the investor. Let's move to the valuation of bond, the fair price of bond. So we have two types of compounding bond. The first one is annual compounding bond. The second one is non-annual compounding bond. So the pricing of bond is comprised of two components. The first one is present value of the annuity of coupon payment plus present value of the single cash flow from repayment of the principal at the maturity. So when you want to make investment decision, you should not invest in bond when fair value of bond is less than market price of bond, or we call it as an overpriced bond. You should only buy a bond or invest in bond when fair value of bond is more than market price of bond, or we call it as an underprice of bond. So the diagram shows how we calculate the bond without call feature. Let's say the bond issue in year 0 and the bond is expired in year 4. So every year from year 1, year 2, year 3 and year 4, the company needs to pay the coupon payment. And then at the end of year 4, company needs to pay principal or par value to the investor. So to calculate the bond price of fair value of bond, you need to calculate the present value of coupon payment, and then you need to calculate the present value of principal. For example, calculate price of 20 years bond that pays 9% coupon per annum with principal at RM1000. The required rate of return is at 10%. The current market price of bond is at 980. So if you plot in the timeline, the market price of bond is 980. You need to calculate the coupon payment in ringgit. So coupon rate is 9% times 1,000 the par value. You get 90 ringgit. That means the coupon payment is 90 per year. Interest rate or the required rate of return given here is 10%. The coupon is compounded annually. That means M, number of compounding, is equal to 1. At the maturity date, which is at the year 20, the principal paid or the par value paid by the company is 1,000. So we can use financial calculator to calculate the fair value or the price of bond today. So first, you need to clear the data in your financial calculator. You press second, reset, enter, CEC. Then you plug in N is equal to 20. That is a maturity period for the bond. IY is the required rate of return is 10%. You plug in 10. Future value is the principal. In this case is 1,000. And then PMT is the coupon payment, 90 ringgit per year. Then compute PV, you get 914.86. So the fair value of bond or the actual value of bond is 914.86. But currently, the bond is selling at 980. So you should not invest in the bond because fair value of bond is less than market price of bond, or the bond is overpriced. This is example for price for non-annual compounding bond. Calculate price of 20 years bond that pays 9% coupon semi-annual with principal at 1,000. The required rate of return is 10%. The current market price of bond is at RM 900. So you can draw the timeline for this bond. The market price of bond today is selling at 900. The coupon payment is 90. You calculate the coupon payment, 9% times 1,000, so you get 90 ringgit per year. Then the required rate of return is 10%. The annual compounding is 2, and the principal or the par value of the bond is 1,000. So if the interest rate or the coupon is paid semi-annually, that means the annual compounding number, which is M, is equal to 2. So coupon payment, you need to divide by 2. So instead of 90 per year paid annually, you get 45 ringgit paid twice a year. So you still get 90 ringgit per year, but it paid twice a year. So the PMT becomes 45. The IY, or the required rate of return, you need to divide by 2. So instead of 10%, you get 5%. And the maturity date, which is N, 20, you need to multiply by 2, number of M. So the N become 40. So when you calculate using your financial calculator, you clear the data and then you plug in 40 for N, number of years. IY is 5%. Future value, FV is the par value of principal, 1,000. PMT is 45, and then you compute PV, so you get 914 ringgit 20 cents. So when you compare with the market price of bond, the bond is currently sell at 900. So the fair value or the actual value of bond is 914. So you should invest in this bond because the fair value of bond is more than the market price of bond. So this bond is under price of bond. So this is example price for annual compounding bond with call feature. Company ABC issued a 20 years bond that pays 9% coupon per annum with principal at RM 1,000. The bond can be called in year 12 at call price 1,200. The required rate of return is at 10%. Would you invest in the bond if the company exercised their call features of the bond if current market price of the bond at 980? So when you draw the timeline for this bond, the market price currently at 980, the coupon payment is 90, 9% coupon rate times par value 1,000, so you get 90 ringgit per year. The annual compounding M, number of M, is equal to 1 because coupon is paid annually. The required rate of return, IY, is 10%. You have call price in year 12. So call price is 1,200. The call date is in year 12. So when you have call features and you want to calculate the price of bond based on the call price, so you need to change the future value in the financial calculator to the call price instead of principal. So if you look at this slide, to calculate the bond futures, the bond price using financial calculators, you clear the data. Number of N, you replace with number of call date, which is 12 years in this example. IY, 10%. Future value, you replace with the call price, which is 1,200. PMT is 90. Compute PV, you get the answer 995.59. So when you compare with the current market price of the bond, so your current market price 980, you should invest in the bond because fair value of bond is more than market price of bond. Next is the example price for non-annual compounding bond with call features. Company ABC issued a 20 years bond that pays 10% coupon quarterly with principal at RM 1,000. The bond can be called in year 12 at call price 1,200. The required rate of return is at 10%. Would you invest in the bond if the company exercised their call feature of the bond if current market price of bond at 998? So current market price is 998. The coupon payment is paid quarterly. That means number of compounding is 4. So coupon payment 10% times 1,000. Coupon payment per year is 100 ringgit. Divide by number of which is 4. So you get 25 ringgit. Required rate of return is 10% per year. Divide by number of compounding 4. You get 2.5%. Call price in year 12 is 1,200. Call date is in year 12. So you need multiply with number of so you get 48. So you plug in all the figures into your financial calculator. N equal to 48, IY 2.5. Future value is the call price at 1,200, PMT 25. And then you compute compute present value, PV, you get answer 1061.13. So when you compare the price of bond now at 998, you should invest in the bond because fair value of bond is more than the market price of bond. Let's move to the valuation of bond, which is by using yield of bond. We have three types of yield: current yield, yield to maturity, yield to call. The yield of the bond. The yield is the rate of return that an investor will get from the investment in a bond. Current yield is the rate of return that investor get by looking only at current income of the bond. Yield to maturity, which is YTM, is the rate of return that an investor get from the purchase of bond at the current market price and hold it until maturity date of the bond. Yield to call, YTC, is the rate of return that an investor get from the purchase of bond at the current market price and hold it until call date of the bond. To make investment decision by using yield of the bond, do not invest in bond when yield of bond is less than required rate of return. You should invest in bond when yield of bond is more than required rate of return. Now, we look at example to calculate current yield of bond. Company ABC issued 10 years 12% annual coupon bond with principal at RM1000. Currently, the bond is priced at 980 at the market. Calculate the current yield of the bond. Would you invest in the bond if your target return is 8%? So first, you need to calculate the coupon payment of the bond. The coupon rate 12% times 1,000, so you get 120 ringgit per year. To calculate current yield, annual coupon payment divided by current market price of bond times 100. So 120 is the annual coupon payment divided by current market price of bond, which is at 980. So you get 12.24%. So to make investment decision, the current yield of the bond is 12.24%. Your target return is 8%. You should invest in bond because current yield is more than your required rate of return. Next, we look how to calculate yield to maturity of annual coupon bond. Company ABC issued 10 years 12% annual coupon bond with principal at RM1000. Currently, the bond is priced at RM980 at the market. Calculate yield to maturity of the bond. Would you invest in the bond if your target return is 10%? So if you draw the timeline, the market price of bond today at 980, the coupon payment, you can calculate the coupon payment, coupon rate times par value, 12% times 1,000, you get 120 ringgit per year. So YTM is equal to IY. So you don't know how much is the YTM. Annual compounding, which is M equal to 1. The principal or the par value of bond is 1,000 and maturity date is 10 years. So you use the financial calculator, you clear the data in your financial calculator, second reset enter CC, You plug in 10 for n number of years, 980 positive present value PV. For future value, you must put negative sign. So negative 1000. And the PMT also, you need to put negative sign. So negative 120 ringgit for PMT. And compute IY, you get IY, you must multiply by number of M. So in this case, M is equal to 1. So you get 12.36%. Okay. Alright. If you look at this diagram, to calculate IY, FV, which is the principal, and PMT, which is the coupon payment, you must put negative. In bond calculation, the 980, the market price of bond today, the financial calculator understand it as a cash inflow for the company. When the company sell the bond, company receive 980. Every year, company needs to pay 120 ringgit. That's why 120, the coupon payment. For PMT, we must put negative sign, cash outflow for the company. And at the maturity date of the bond, the company needs to return back the principal to the bondholder. So the principal 1000 is negative because it is a cash outflow for the company. Okay, so that's why to calculate the IY or the yield to maturity, the current market price, cash inflow, positive. PMT and future value is cash flow, so cash outflow, so we need to put it negative. So investment decision, the yield to maturity for this bond is 12.36%. That means if you invest in this bond and you hold it until maturity date, you will get 12.36%. But your target return is just 10%, so you should invest in this bond because the bond YTM is more than your required rate of return. Next, we look example for yield to maturity of non-annual coupon bond. Company ABC issued 10 years 12% semi-annual coupon bond with principal at RM1000. Currently, the bond is priced at RM980 at the market. Calculate yield to maturity of the bond. Would you invest in the bond if your target return is 10%? So if you draw the timeline, the current market price of bond is 980. The bond paid 12% semi-annual coupon. So you can calculate the coupon payment, 12% times 1000, the par value. So you get 120 per year. But the company paid it semi-annually. So you need to divide by 2. So the PMT is 60. Annual compounding number of M is equal to 2 because the coupon payment is paid semi-annually. The principal is 1000. The maturity date is N equal to 10, but the annual compounding is 2, so N become 20. So you plug in all into the financial calculator, 20N, 980 present value, or the current market price of bond. Future value, you put principal, negative 1000, PMT, negative 60, compute IY, you get 6.18% times by 2, so you get 12.35%. So to make investment decision, the YTM 12.35%, you compare with your target return 10%. So basically, you should invest in bond because yield to maturity is more than required rate of return. So how to calculate yield to call for annual coupon bond? Company ABC issued 10 years 12% annual coupon bond with principal at RM1000. Currently, the bond price is at RM980 at the market. The bond can be called in year 7 at call price 1,150 ringgit. Calculate yield to call of the bond. Would you invest in the bond if your target return is 10%? So if you draw the timeline for this company, the current market price in year 0 is 980. The coupon payment is 120 ringgit. 12% times 1,000. So it's paid annually. So divide by 1, you get 120. Annual compounding M equal to 1. In year 7, you have called it. So your N becomes 7. Okay, the call price, which is the future value here, is 1150. So you plug in all the figures into the financial calculator, number of N, instead of you put maturity date. To calculate YTC, you need to replace it with the call date. So N is equal to 7. Present value, the current market price of bond is 980. The future value, you need to put the call price, which is 1150. We put it negative. PMT is the coupon payment, 120 negative. Compute IY, so you get 13.87 times 1. 1 is number of compounding, which is in this case annual compounding, M equal to 1, so you get 13.87. So when you compare with your target return, you should invest in this bond because the yield to call is more than your required rate of return. Next, I'll show you how to calculate yield to call of non-annual coupon bond. Example, company ABC issued 10 years 12% semi-annual coupon bond with principal at RM1000. Currently, the bond is priced at 980 at the market. The bond can be called in year 7 at call price 1150. Calculate yield to call of the bond. Would you invest in the bond if your target return is 15%? So if you draw the timeline, market price of bond 980, coupon payment 120 per year, divide by number of M. So the bond is semi-annual coupon bond, so you need to divide by 2. That means PMT is 60. Call price in year 7 is 1150. So call price, the future value 1150. Number of N, 7 times M, number of compounding. So N become 14. So you plug in into the financial calculator, 14 for N, 980, the current market price of bond as a present value, 1150, the call price as a future value, 60, coupon payment as a PMT, compute IY, you get 6.90% times 2 number of compounding, so you get 13.79%. So you compare with your target return. In this case, your target return is 15%. Yield to call is less than your target return, so you should not invest in this bond because the return offered by the bond is lower than your target return. That's all for the bond valuation. Thank you.